Hey, it's Tom Nash. Over the last 18 months, my portfolio skyrocketed by 240%. Now, I know what you're thinking. Was this just luck? I can tell you with absolute certainty that it wasn't. In fact, back in early 2023, I made a bold prediction that it would be a tough year for the stock market. Turns out, I was dead wrong about that forecast. Yet, here I am, with a 240% gain. How did I manage to beat the odds despite a flawed prediction? That's what I'm about to reveal. You see, the secret wasn't about frantically trading in and out of stocks or trying to time the market perfectly. Instead, it was about sticking to a process that anyone can replicate. From January 2023 up until now, I was bullish on 9 key stocks: Palantir, Nvidia, AEHR Test Systems, CrowdStrike, SMCI, Tesla, SoFi, and even a less popular one like Bunge. Some, like Palantir and Nvidia, saw explosive gains of over 500% and 200%, respectively. Others, like SoFi and Bunge, didn't perform as well, but that's all part of the game. No portfolio is perfect, and anyone claiming otherwise isn't being honest. In fact, let's look at my own investments. I hold 40% in the S&P 500, 40% in Palantir, and 20% in Tesla. The S&P 500 delivered around 50%, while Palantir far outperformed. Tesla, on the other hand, lagged behind at 30%. The takeaway? You don't need to be right every time, just consistent in your approach. It's about trusting the process and sticking to a system that works in the long run. Now, if you're expecting some secret paid course or a sales pitch, forget it. I'm about to give you the principles I followed to achieve these results for free. There are 3 fundamental pillars to long-term investing success: save more by avoiding unnecessary expenses, invest better by selecting quality stocks, and hold for longer. Yes, the market is volatile, there are crashes, wars, and economic uncertainties. Yet, the S&P 500 has still returned around 700% over the past 15 years despite all the turmoil. That's why the long game works. Let me give you a classic example. People always ask, Tom, is it too late to invest in Palantir, Tesla, or even Apple? The answer is simple: if it's a good company, it's never too late. Look at Apple. Back in 2000, it was worth just $1 a share. By 2010, it reached $7, then soared to $50 in 2020, and climbed further to $230 in 2024. The price gains are irrelevant. What matters is the quality of the business. As long as the company remains solid, the stock will continue to rise over time. Here's the catch: markets don't move in a straight line. They zigzag with ups and downs, but the trend for good companies always points upward. So stop obsessing over short-term fluctuations and zoom out. Look at the bigger picture. Bad days don't matter as long as you're in it for the long haul. And here's one of the most powerful tools you can use: dollar cost averaging, DCA. By consistently buying stocks at regular intervals, regardless of market conditions, you'll lower your average cost over time. But here's the trick: buy even more when the market sentiment is negative. When everyone else is panicking, that's your chance to build your position at a discount. At the end of the day, it all comes down to selecting quality companies. You can follow all the strategies I've mentioned, but if you invest in bad businesses, none of it will help. That's why understanding how to evaluate companies is essential. It takes time, effort, and a bit of learning, but the rewards are worth it. So, take the plunge, give it a shot, and if you're looking to dive deeper, my academy is here to help. You'll learn skills that can set you up for life, and if you're not satisfied within 30 days, you get your money back. No questions asked. Thanks for tuning in, and remember to like, comment, and subscribe. See you next time.